Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's stories with you. We're starting off with a look at the electric vehicle industry in China, where demand is slowing down and costs are rising. According to recent reports, January sales for some of the top EV manufacturers, including BYD and XPeng, were significantly lower than expected. This decline in demand is being attributed to lower government subsidies and increased competition in the market. But that's not all. The industry is also facing rising costs for raw materials such as lithium, copper, and aluminum, which are used in the production of EV batteries. This cost inflation is putting pressure on automakers' margins, making it even more challenging for them to turn a profit. Some analysts are warning that we may see large-scale earnings downgrades this year, which could have a significant impact on investor sentiment. In fact, bearish positioning in EV stocks on the Hang Seng Tech Index has been increasing since November, indicating that many investors are already betting against the sector. Despite these challenges, there are some positive developments on the horizon. Improving trade ties with countries like Canada and the EU could help drive export momentum, and some automakers are exploring new technologies such as AI and robotaxis. So, what does this mean for investors? Should you be avoiding the EV sector altogether, or are there still opportunities to be found? We'll be discussing this topic in more detail later in the show, but for now, it's clear that the industry is facing some significant headwinds. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the fascinating world of finance and technology. Today, we're exploring the lucrative business of financing AI initiatives and how banks are playing a prominent role in providing finance for data center-related investments. Now, I know some of our listeners might be thinking, AI? Isn't that just a bunch of buzzwords and futuristic concepts? But let me tell you, the numbers are real, and they're impressive. According to Moody's ratings, at least $3 trillion is set to flow into data center-related investments over the next 5 years. That's a staggering amount of money, folks, and banks like MUFG and JP Morgan Chase are right in the thick of it, providing debt packages to fund massive data center projects. In fact, just last year, they led a roughly $38 billion debt package to fund data centers connected to Oracle Corp. in Wisconsin and Texas. That's one of the largest ever such deals for AI infrastructure. But what's driving this trend? Well, it's quite simple, really. Insurers, pension funds, and Middle Eastern sovereign wealth funds are all looking for higher returns on their investments, and project finance is becoming an increasingly attractive option. And banks like MUFG are happy to oblige, offering collateralized loan obligations that are slightly riskier but diversified. Now, I know some of our listeners might be thinking, but what about the risks? What if these AI projects don't pan out? Well, that's a fair question, and one that Nakahama, the head of MUFG's division, addressed in a recent interview. He said that the bank is being careful to select players they do business with, and that it's not just about looking at data centers, but also paying attention to the entire ecosystem. And speaking of ecosystems, it's worth noting that Japan's 3 megabanks have just completed another strong earnings season, with lending income rising and further gains from selling stakes in corporate clients. MUFG's net income rose 6% from a year earlier last quarter, putting it on course to achieve its target for record annual profit. But as the banking landscape continues to evolve, executives face the task of ensuring growth beyond these tailwinds while also improving capital efficiency. Nakahama said that his division has been phasing out low-profit transactions in recent years, bringing the team's return on equity to 7.5% in the year ended last March. So there you have it, folks, a fascinating look at the world of AI finance and the role that banks are playing in shaping this rapidly evolving landscape. It's a story that's full of intrigue, innovation, and of course, risk. Welcome back to the Riskwiser Zone. Today, we're diving into the latest developments in the world of artificial intelligence, specifically the advancements made by Anthropic's Claude AI model. The recent release of Opus 4.6 has sent shockwaves through the tech industry, with its enhanced capabilities and integration with major platforms like PowerPoint. Now, let's break down what this means for investors and businesses alike. On one hand, the rapid adoption of enterprise AI solutions like Anthropic and OpenAI is a testament to the growing demand for innovative technologies that can streamline processes and boost productivity. The data suggests that average enterprise LLM spend has increased by 150% from 2.5 million in 2024 to 7 million in 2025, with projections indicating a further 65% increase to 11.6 million in 2026. On the other hand, this surge in AI adoption has also led to concerns about job displacement and the potential disruption of traditional industries. The recent stock market volatility, with companies like Thomson Reuters and LegalZoom.com experiencing significant single-day drops, is a clear indication that investors are taking notice of these developments. It's essential to approach this topic with a balanced perspective, acknowledging both the benefits and risks associated with AI integration. While Anthropic's Claude AI model has made significant strides in terms of capabilities and accessibility, it's crucial for businesses to carefully consider their investment strategies and weigh the potential returns against the potential disruptions. NVIDIA's CEO Jensen Huang's comments that fears about AI replacing software and related tools are illogical are noteworthy, as they highlight the complexities of this issue. Similarly, Mark Murphy's observation that it's an illogical leap to assume a new plugin from an LLM would replace every layer of mission-critical enterprise software serves as a reminder that we need to separate hype from reality. As we conclude today's episode, it's clear that the AI landscape is evolving at an unprecedented pace. While there are undoubtedly opportunities for growth and innovation, it's essential to remain cautious and informed. As investors, it's crucial to stay up to date with the latest developments and assess the potential risks and rewards associated with AI adoption. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.